Over the weekend, we learned that the Japanese markets fell precipitously. They had their worst crash since 1987 this past weekend. And a lot of the reason for this is what they deem the carry trade. And so a lot of people have been asking, what the heck is a carry trade, you know? So what does a carry trade actually mean? So imagine we're back in 2020 and we can get a home equity loan for 3.25%, let's say, and the market's really low and you're super aggressive, somebody's super aggressive, and they want to borrow against their house to buy a bunch of stocks. Now, we wouldn't recommend this, but let's say somebody did this because they were super aggressive, they were borrowing at 3.25%, and they wanted to buy a bunch of stocks, and so they bought a bunch of stocks in March of 2020, and the market went nuts since then, and things have gone up and up and up. And so they made a lot of money, and the Fed, of course, starts raising rates. And so suddenly that 3.25% is 8% and going up to 9%, and you're saying, I can't continue to pay 8 and 9%. I'm going to pay off this loan, and in order to do this, I got to sell my stocks. So that's exactly what these hedge funds are doing right now, except instead of borrowing on their houses, they are borrowing against the Japanese. And the difference also is that the Japanese yields were less than 0%. Now they're more like 1.2% or something like that. But the Japanese yields were very, very low. And at the same time, the dollar was appreciating in value versus the yen. So the yen gets weaker and weaker, the dollar gets stronger and stronger. So they don't have to pay back as much because they got negative yields and the yen is getting weaker. And they get to buy things that are going up in value, so they're winning on both sides of the trade. But when this starts to change, that isn't so good. And so they're saying that there was about $4 trillion of unwind that happened over the weekend as these hedge funds paid off their loans and sold off the stock. And so we can see that this also may continue for some time because this is just the tip of the iceberg. This is just the tip of the spear. These hedge funds have been unwinding a little bit, but now this unwinding is increasing in magnitude and velocity. And there's a lot more out there where companies and financial institutions have been borrowing from the Japanese. It looks like with interbank loans is running around $125 trillion, and with loans to non-bank financial institutions is running around $250 trillion. There's a lot of loans out there. Japan has been loaning a lot of money. And a lot of people have been wanting to borrow because they hadn't had to pay much back. But that is starting to unwind. And so there's an article here that we pulled up that explains this a little bit more. Consider if you borrowed 10 million yen a month ago and immediately converted it to US dollars, you'd have had to pay back about $62,000. But given the way the yen has surged recently, you would need about $70,000 to pay back that loan today, even without taking into account any interest or anything like that. And put another way, you need to have made roughly 13% on the borrowed money in 1 month just to get back to even. So it isn't easy to get back to even when you have to make 13% a month. And so people think that, well, hey, I don't like this. I'm going to pay back what I've borrowed and sell a few things so I'm not going to be losing on this side of the trade. And so they've been selling a lot of the things that they've been made a lot of money on, some of the things that they may think are overvalued here. And a lot of that may be things like the Magnificent Seven stocks and some other things that have really run up in value. If you couple that with what's happening in the economy, of course, last week we saw that the unemployment rate has spiked up to 4.2 and then 4.3% in July. And so people are worried about that too. So people are worried about a recession here in the U.S. They're worried about interest rates increasing in Japan and having to pay back a lot more than they borrowed in dollar terms. And that isn't good. And so people are unwinding their leverage. They're over-levered, they're unwinding their leverage, and this over-leverage leads to larger sell-offs. This over-leverage can also lead to short covering as well, so we might see some rapid rises and be able to sell a few things on these rapid rises. But they're unwinding the leverage, and as they're unwinding the leverage, that causes some of these sell-offs. So right here it shows what the yen has done over the last year. and it goes back to January, and you can see that the yen has been going down in value most of the year until around July 4th, and then it stopped going down. And since then, the Bank of Japan has been saying they want to raise interest rates, and it spiked precipitously. This has gone up really fast, and so people are concerned it's going to keep going up really fast, and some of these people are being forced to sell some of their stock and pay back these loans. So when someone is a forced seller, that's not a good situation for them to be in and pay back the loans. And of course, we have a market that seems pretty overvalued here. When we look at where the market is measured by the Buffett rule, Buffett likes to measure the market by how overvalued it is or undervalued it is based upon the total market cap divided by the gross domestic product. And you can see that in the year 2000, it was about 150% at its high, 140, 150%, and now it's closer to 200%. And so it's about as overvalued as it's ever been based upon Buffett's favorite metric to value how expensive the market is. And so Buffett, over this past weekend, also let us know he's been freeing up a ton of cash. So his cash hoard is now close to $280 billion. I think as of the end of June, it was $277 billion in cash and treasuries. Buffett owns more treasuries even than the Federal Reserve right now. He owns a ton of treasuries. And so Berkshire Hathaway owns more treasuries than just about anybody. He's been buying them up in spades, all kinds of treasuries, and he's been selling stock. And right now, his treasury hoard exceeds that of anything else that he owns in his entire marketable securities portfolio combined. It's over 50% of his marketable securities portfolio. It's almost 30% of the value of Berkshire Hathaway right now, especially with the drop in Berkshire Hathaway since the weekend. And so we are seeing Buffett in a place where he likes bonds more than he likes his own stock. He likes bonds more than he likes anything, and he's been selling a lot. The only thing he's been buying recently has been Chubb and Bank of America stock and a little bit of Liberty Media Sirius. And so he's been selling, over the last 2 weeks, he's been selling a lot of Bank of America stock. We've seen a lot of sales go through for that. But over the weekend in the 10Q, which is the quarterly report, he showed that he sold about 390 million shares of Apple. And so he's been selling it all over the second quarter. By the end of June, he'd sold 390 million shares of Apple. It's likely he continued to sell into July. He may even be selling today for all we know, but he's been selling off a lot of Apple. Now, some people may say, well, he didn't sell all his Apple, so he still likes Apple. Well, he probably still does like Apple, but obviously he feels there's a lot of other better buys out there that he may be able to buy in the near future when the market comes down and offers better values. And so he doesn't want to own Apple at these valuation levels, and so that's what he's selling. And so selling that much Apple tells us that Buffett thinks Apple may be overvalued here, and there may be a lot of things that we want to go out and buy later on. He thinks that things may be coming down from here. So, and some people may say, well, he didn't sell all of his Apple, but if you're selling hundreds of millions of shares of stock, it takes a while. You can't do that all in one day. Otherwise, you're going to send the stock down to zero or close to zero. You got to do it over time. But what happened over the weekend is a lot of people, they were unwinding their yen carry trade. They're paying back the Japanese, and the Japanese yen continued to spike. The Japanese market sold off. People sold off a lot of the shares they owned in the market, and that is causing volatility that we haven't seen in years. The last time we saw volatility, and this is the volatility or VIX index, it measures the fear in the market, and the volatility hasn't reached these levels since the pandemic. And we also saw these levels in the great financial crisis, and we saw these levels in 1987 and that big drop off in 1987. So we haven't seen these things get this fearful in a long time. Now, this is just the front end of it. Usually when we have one shoe drop, we have to wait for the other shoe to drop. When we have cockroaches in the kitchen, we usually look for other cockroaches because there's usually other cockroaches around. So what we want to look for is what else is going to be coming. It's likely that all the unwinding of the yen carry trade is not over. It's likely that when there's forced selling, there's other forced selling to come. And so we want to look at other things like the breadth in the market to see where we are. And this is a chart that shows the breadth in the market. Right now, we're around the mid 30s of the companies that are above their 50-day moving average. And so usually what that means is that over 60% of the companies out there are below their 50-day moving average, and that means that they're starting to look not so hot as far as technicals are concerned, or the market action is concerned. When we get down to this level, usually there's a lot more down to follow. We usually don't bottom until we get into the single digits or in the teens, where there's only that amount of companies that are above the 50-day moving average. And this right here measures the percentage of stocks in the New York Stock Exchange that are above the 50-day moving average. So it looks like we still have a little ways to go before we bottom out. What we recommend is that we do like Warren Buffett. We start freeing up cash. If you hadn't already, start freeing up cash, start buying short-term treasuries. You may actually look to buy some longer-term treasuries as the short-term treasury yields come down. Look at buying things like gold and short-term treasuries, things that are going to preserve your capital, and wait for lower valuations in the future. Wait for those bargains to come up that we can buy at lower prices, because it looks like a recession's on the way and we might be able to buy a good bit at lower prices here in the future. So as always, please stay thirsty for knowledge, put those thumbs up and subscribe. We'll catch you next time.